If in the March 2020 crash, you would have invested 100 rupees in the stock market, that 100 rupee would have become 200 rupees by now. I'm speaking generally. I'm not telling you exactly which date you would have invested in and all that, but I'm just generally telling you that if you would have invested around 100 rupees in 2020 March, it would have become 200 rupees now. Very simple. Now you might say that, hey Akshat, why are you khading gade murde? We know that you made money in that crash. Other people also made money in that crash, but we missed the bus. So why are you telling all that stuff? I'm telling you all that stuff because there is a very important lesson there. That if you understand economic cues, you can actually make a lot of money in the stock market. The same reverse trend is going right now. And I'm going to explain that economic scenario right now by analyzing Professor Aswath Damodaran's interview that he gave to CNBC very recently, where he discussed entirely about cryptos, about Zomato's valuations, about whether we are in a stock bubble right now or not. Very important for you to understand Professor Damodaran's viewpoint. For people who don't know who Professor Aswath Damodaran is, he is a valuation expert. Students at Harvard Business School also study from his books. He is one of the most celebrated valuations experts in the world. So do consider his viewpoint very seriously and understand closely what he is saying on this interview. I'll play some clips along the way. So on this video, I'm going to do three things. One, I'm going to help you understand Professor Damodaran's viewpoint, whether we are in a stock bubble right now or whether things are hunky-dory. Second, I'm going to help you understand more about my investment strategy, what am I doing and how am I curating after listening to viewpoints of Professor Damodaran and other research I have done, and how am I playing the stock market right now. And third and finally, how you should go about playing in the stock market too, right? So I'll give you my viewpoint. Please do not consider this video as an investment advice. Please do your own due diligence. I analyze all these economic trends, specific fundamental technical analysis, and only then I make investments. But like any other investor, including Mr. Warren Buffett, I can be wrong as well, right? So please do your due diligence, and market can be a very complex game. Before we go further, I am sure that there will be a subset of people, very small subset of people who would be sitting on the sidelines. They will say that, hey Akshat, you know what? Market is overvalued. We are very smart investors. We are going to jump in when market crash. Now, there are more people who have lost money just waiting for crashes than people who have actually lost money in the crash. So please remember that quote as well. It was given by someone. Do comment on the comment box who gave that quote. I have explained that earlier. I will check your answers. So let's start this video. So let's first and foremost understand that according to Professor Damodaran, are we in a stock market bubble? According to him, the answer is no. There are two very concrete reasons that he has given, and third, he has given a prognosis. So let me discuss all these 3 points. First, listen to this clip.
Warren Buffett loves this market cap as a percent of GDP, but there are things that Warren Buffett uses that should not be used. This is a really bad metric. And here's the reason. India has historically been an economy driven by private businesses, family-owned businesses. That's the history of India. As countries increasingly incorporate and go to a trading market, that percentage is going to rise. So even if nothing changes about India, the market cap as a percent of GDP should keep going up, whatever you think about markets. There are other metrics you can point to and say, hey, Indian markets are overvalued. But that metric doesn't in the least bit convince me about anything about the Indian market. I think that are Indian investors being optimistic about the future? Yes. Are they being over-optimistic? That's, I think, something we can back out from the market and ask, is that a reasonable assumption to make about the future?
Now, essentially what Professor Damodaran is saying, that market cap to GDP ratio is also called as Warren Buffett indicator. And Warren Buffett has been very prominent in terms of outlining the importance of this market indicator. So we need to consider it seriously. But this analysis does not work for a market like India. So let me add on to what Professor Damodaran has said. Now, if you take a look at this chart, you will see that the market cap to GDP ratio of India has jumped to a 20-year high as we are sitting in 2021. Now, this looks very scary, right? And that is what the interviewer was also asking Professor Damodaran. But what you need to understand in India's case is that historically the ratio has been low, right? It has not traded very high. Now it has gone up suddenly. What was the reason for it? Now the reason is 2020 Corona crash. Now in 2020 Corona crash, what happened was that there were countries like the US that printed trillions of dollars. When I say printed, they basically brought in that money into the economy or flushed that money into the economy. That money came to countries like India also, right? Because of which what happened? Because of which the stock markets went up. Why? Because the market cap of all the listed companies went up, right? That is what is happening. That because of excess liquidity, the market cap of companies have gone up, right? So the numerator went up, right? And what happened to our GDP? The GDP of India in the last 2 quarters has shown a decline or increase. Decline, massive decline in the last 2 quarters. So the denominator went down. So what would happen to this entire ratio? It will go up, right? That is the mathematical explanation. This is something that Professor Damodaran did not spell out exactly. What he simply said was that, hey, you know what, India has like family business orientation. So this GDP number does not get captured. So India traditionally should have always displayed a very high market cap to GDP type of a ratio. Because in India, if you know that majority of our GDP comes from where? Informal sector. Now that does not get featured into the denominator. Right? So please remember all these basic things before you start believing in indicators like, hey, market cap to GDP. Mr. Warren Buffett is not incorrect, but his ratio is incorrect in India's context. So this is the first key point that you need to remember from this entire discussion, that a lot of people right now, they will say that, you know what, market cap to GDP of India is very high, therefore you should sit on the sidelines and not invest your money. Show them this. Hopefully they will understand. If not, so be it, right? So let's move on. Now, just to add one final point to market cap to GDP ratio, in 2003, this ratio was 130 for the Indian market, 133%, which was still overvalued, but the market went on to produce all-time highs over the next few years. As of 2020, the ratio stands roughly at 150%. So the bottom line is that in a very efficient market like the US, if the market cap to GDP is between 50 to 75, then the market is undervalued. If it is between 75 to 100, then the market is fairly valued. If it goes above 100, it is somewhat overvalued. But that works for efficient markets like US. Now, I am not trying to criticize the Indian market, but we all understand that because of the nature of India's economy, our GDP numbers are not correctly measured. Lot of misinformation is there. So the market is inefficient from that angle. Therefore, do not solely rely on these type of metrics to sit on a pile of cash and not do any investments. So that is the first key point that you need to understand about Professor Damodaran's interview. Now this brings us to the second clip about PE ratio, which is one of the favorite talked about investor ratios in the world. So listen to this clip.
If I take 2020 earnings, I get a very different PE ratio than 2019. Normally with markets, you don't care that much. But at this point in time, you need to care. Why? Because 2020 was just an unusual year. So, we can make an argument based on PE ratios, but it's got to be based on something beyond last 12 months of earnings, because we are in unusual times. And I would say this about every market in the world. The earnings in the last 12 months are not a great metric to scale up on, because it reflects an economy that was shut down, at least for a portion of those 12 months.
Now, what Professor Damodaran is saying is very simple again, that he's simply saying that, you know what, the price to equity ratio right now for India is very high. In fact, for the entire world is very, very high. But you need to understand both the things. First, the price is high. Second, the earning is low. Therefore, the entire PE ratio is high. Okay, let me simplify this. Now, what has happened due to 2020 coronavirus is that the earnings multiple, the earnings in 2020 for majority of the companies had gone down, right? It had gone down clearly, that a lot of companies were not producing, factories were just not there, people were not buying enough stuff. Some industries like travel entirely shut down. Cinema companies like PVR, which had massive chain and infrastructure of theaters, they had to close down literally, right? So the earnings went down like anything, right? Because of which this entire ratio moved up. So that is the simple point that you need to understand from this part of the conversation. Important point or very important point here is that PE ratio is a growth indicator, right? Now, as earnings improve, right, in 2021, 2022, this PE ratio will automatically come down, and you will keep on wondering that, you know what happened? PE was so high, market did not crash, but now PE looks sensible. It looks sensible because the earnings have improved. The denominator has gone up, therefore the entire PE ratio has come down, right? So please keep this in mind. Another key important point that he mentioned in the form of a question was, and it's a very legitimate question to ask, that okay, great, you know what, stocks are overvalued, right? Let's assume that everything is overvalued in the stock market right now. Tell me, where are you going to invest? Are you going to invest in FDs? They are giving less than 4.5% real return, right? Inflation is 6%. You are 100% losing money on FDs. That's one. Second, are you going to invest in real estate? Again, real estate is overvalued. Why? He has not given an explanation. So you can check this video here. I have made a separate video on real estate. So that will help you understand why the real estate is somewhat in a bubble and why the real estate market is unlikely to grow in the future. So please watch this video, very important video. So bottom line is that you can't invest in FDs, you can't invest in real estate, right? FD are bonds, right? So you can't invest in bonds, you can't invest in real estate. Alternate commodities are also fluctuating. So where will you put your money? You will say that, okay, I'll keep it in my savings account. That gives you like 1.5%, 2%. Again, you will lose your money. So you have no other option but to invest in businesses, right? Invest in businesses. That is very, very important point for you to understand, because at least they are taking advantage of the inflation, right? When the extra money that is being printed and being flushed in the economy, who gets that money? Somehow companies get that money at the end, or banks get the money in the end, right? Because we will get the money, we will spend it, eventually it reaches the companies. Their earnings grow and their share prices grow as well. So bottom line is, if you are investing in businesses, that's a good move as of now. Yes, from a PE ratio point of view, it might appear that the businesses are overvalued, but what other alternatives do you have? Now comes the third critical point from this interview, where Professor Damodaran clearly said that stock markets are giving different signals and bond markets are giving completely different signals. So let me explain that point, but first watch this clip.
That there is a disconnect here between what bond markets are saying and what stock markets are saying. Let me explain. Stock markets are suggesting, a very strong return to growth and a very strong return to the consumer. That's what stock markets are saying. Bond markets are giving the opposite message: low growth, low inflation. There's a disconnect here. One of these markets has to adjust, and your best case scenario is that that adjustment happens gradually.
All right, so this is what Professor Damodaran says, that he says stock market is giving the signal that, hey, inflation high and growth high. So you must invest in businesses to actually benefit from that growth. What are the bond markets saying, right? So stock markets and bond markets are two primary markets, right? So we all are aware of stock markets, but we hardly talk about bond markets. But bond markets are also very, very important. In fact, bond markets are much bigger compared to stock markets. So bond markets are saying that, hey, you know what, in the future, inflation is going to be low and growth is also going to be low, right? So these two major markets are saying two very, very different things. That is the reason why investors are getting confused. Now what happens is, now from a practical viewpoint or from an investor's viewpoint, what you need to know is that when the stock market looks more attractive, when the potential of the stock market looks or appears to be high, the money flows from bond market to stock market. Very obvious, right? And the opposite happens if the bond market looks attractive. Now this attractiveness in the bond market actually comes from something called as yield, right? So yield essentially means returns. So for example, a 10-year treasury bond might have a yield, hypothetically speaking, let's say 3%, right? Now, if they suddenly increase this yield to 3.5%, you will see a lot of money being moved from stock market to bond market. But on the flip side, if they cut the yield from 3% to 2.5%, the money will flow in the opposite direction. So please keep this in mind. And Professor Damodaran says a very interesting point that, hey, you know what, this particular change might happen in two ways. Now this change might happen slowly. Now slowly what would happen is that the yield of the bond market will be slowly increased with time, right? Slowly increased. So the excess money that is currently available in the stock market, that will flow where? Comment. That will flow to the bond market. Second, it might happen as a knee-jerk reaction, right? Knee-jerk reaction means that, hey, one morning Fed gets up or some major government gets up, they say enough with this stock market hoopla, we are increasing the yield of the bond market, and suddenly there will be a massive outpour of money from the stock market to the bond market, right? So these type of changes can happen slowly, and these type of changes can happen in a knee-jerk fashion. Now my assessment is that this will happen slowly with time. This will happen very, very slowly with time, because market hates surprises and no country in the world would want to shock their stock markets. So this knee-jerk theory would not really work out unless something dramatic happens. And just to build on this point, this is what Professor Damodaran said about central banks. These are not my words, these are his words. He said that central banks are insane. I've been saying it in another very diplomatic way. When I advocate investing in cryptocurrencies, we'll talk about that as well. But bottom line is that central banks assume that they have a lot of power, but they actually do not, right? They do not control to the extent we think that they control the economy, because certain things are not in their hand. How will the inflation play out. They have no control over it, right? They can try controlling it, but sometimes things go completely out of hand. So this tapering thing will happen over time in a natural way. Till then, there is no point in panicking. So with all this information, what is it that I am doing? So there are three things that I am doing. So number one, I am investing in India because I truly believe that the next few decades are going to belong to India. So if you're a beginner, you can consider investing in something like the Great Indian Middle Class Low Cost Fund. The volatility is medium on this type of a small case. You just go and invest. Let's just quickly take a look at what type of exposure you would get. So you would get exposure to a range of different enterprises that benefit the middle class. As the middle class grows, the Indian economy will grow with it. So you could invest in this small case because it gives you access to a very well-rounded investment portfolio across paints, automobiles, and bunch of other different household products. Second, I'm going to stay away from overvalued stocks. So there was a small discussion around Titan, how its PE has been very, very high. There are always stocks like these that are super inflated. Therefore, at this juncture, I'm staying away from pharma, I'm staying away from tech, I'm staying away from something like Titan, for the simple reason that there are certain sectors within the Indian economy that I feel are slightly overvalued. So I would stay away from it. If you want me to make a separate video on tech related stocks, I'll make a separate video. Why I'm not super bullish as of now with them. This does not mean that these tech stocks are bad. Of course, there will be massive growth in these stocks, but for now, they seem to be little overvalued for me. My third and final strategy is that I'm hedging by buying cryptos. Now, here is a clip. Listen to it. This is what Professor Damodaran had to say about crypto investments.
I would argue that the reason you've seen the rise of not just cryptocurrencies, but NFTs, you've heard of these, right? Little video clips that sell for, $750,000 is for that segment of the market. And it's not a small segment. 10 to 15% of the market is billions of dollars, maybe even trillions of dollars, is looking for somewhere to put your money.
Now, building on from his interview so far, it is very clear that there is a good 10 to 15% population that believes in cryptocurrencies. This includes me, right? I'm in that 10 to 15% people who believes in the crypto narrative. Now, for me, crypto is a hedge, and I would always do 10 to 20% hedge. It could be buying short or put calls. It could be buying gold. It could be investing in cryptos. So I'm doing away. I'm not buying any call and puts. I'm not buying any gold. I'm simply taking that hedge money and putting that in cryptos, right? Why? Because we don't know how the governments are going to engage when it comes to this tapering effect. People discount it so much, people get so worried about that, hey, government might ban cryptos, all this stuff, there will be some new regulation, new bill. No, government cannot control cryptos. If they would have had the option of doing it, they would have already done it. Why did they wait for so many years for cryptos to blow up? They can't do anything about it, right? Let it be. What we should rather be scared about is how the stock market and bond market might find convergence. That is something that we need to see, because at one point this is going to happen, and that is the time the stock markets might come down. To what extent, we don't know, no one can predict. But for that precisely, I am buying a hedge, because the moment stock markets crash or come down, guess what is going to happen to the crypto market? It will boom, right? So even if I have 10-20% of my money invested in cryptos, that will hedge for all the losses that I'm making in the stock market. If everything goes hunky-dory, if stock market is stable, or if the tapering effect is very sensible, if it is done slowly, then stock market will not tank much. It will keep on growing. So my 80% of the portfolio will grow. 20% of crypto portfolio will somewhat stay stable or grow very slowly. Now comes the final section, that what should you do? Number one, if you are a beginner, invest in India. India is one of the regions or countries which will depict massive growth. So you will benefit from it. Invest via small cases, invest via mutual funds, invest in anything that you understand, right? So that is tip number one. Number two, be diversified. Now I'm not saying that go and buy cryptos, you can go and buy whatever, right? But have a little bit of a hedging strategy. I told you my hedging strategy. Now you pick your own hedging strategy. Number three, stay away from overvalued things. So this brings us to the homework of today's video. That why do you think a company like Zomato is highly overvalued? The answer was there on Professor Damodaran's interview. You can figure out that answer, read his blog. He has written an excellent analysis on this. This will teach you more on how to do valuation and get better in stock market and financial analysis game. So I hope you enjoyed the video. Do give it a thumbs up. Do tell me if you would want me to continue making these type of heavy economics related videos, and I shall do the same. Thank you so much for watching, and I'll see you the next time.